Hi everyone, welcome back to BeRich. It's me Vinod, and I hope Mr. Vijay Radhakrishnan is happy with my attire today. He was rather upset that I was not in a formal shirt. I kid. I jest, Mr. Vijay. I do understand. It is nice to see sense of what you call seriousness when you're wearing a shirt and when you're in the office. I can relate and I can understand. But there are some interesting comments which I got in the video yesterday. So I just wanted to have a quick walk through the comments and offer my feedback, because this is the only way I can give you my feedback, since this is a one-way street. Suresh Balaji 988 said, bond versus gold versus Berkshire. How to buy US T-bills outside US? Well, that's a very nice, thoughtful comment from you, Suresh. You're absolutely right. Buffett moving 5% of his cash into T-bills is a signal. It's not a prediction. He's building safety and optionality, as I was saying in the video. But your question, bond versus gold versus Berkshire, depends on your goal. If it is capital protection, short-term bonds is good. If you're hedging against currency debasement, gold is good. And if you're looking at long-term compounding with a solid business, Berkshire is good. I hope that kind of gives you a clarity between bond versus gold versus Berkshire. And in terms of buying short-term US bonds, if you're outside the US, you can do it via international brokers like IBKR, which is what I'm using. You can do it through ETFs like SGOV or BIL, okay, which are available on IBKR for Indians with LRS. Make sure you're FEMA compliant and LRS if you're based in India, okay. And the next comment was MMVT7BE. You follow Buffett blindly. Tech stocks matter. I hear you, man. You're right. No investor should follow anyone blindly, not even Buffett. Let's not forget. But Buffett did invest heavily in Apple, even praised it as probably the best business I know, he said. So, what we try and do is learn from the framework and focus on safety, optionality, and value, and understanding the business is important, and not copying his trade. So, I get what you're saying. And tech has its place, but understanding that what you're paying is key. Like what Charlie always used to say is, whether it's Nvidia or Nestle, value always matters. The price which you're paying always matters. The company is important. So tech is important. I do agree. MMVT7BE. Nanban 2000 says, Anand says Vinod does. Yes, I am guilty of charged. I am guilty as charged. Honestly, I would like to think more of it like Anand analyzes and Vinod experiments. I would say probably sounds better. We both do our own work. We do agree sometimes. And it's because numbers and fundamentals align, not because of family loyalty. And this is not a Lala channel. But luckily, to have a brother like Anand who challenges all my ideas is great. And he does push me constantly, he pushes me back. And you guys should see the kind of debates we have over our coffees and our tiffins. It's quite interesting. I wish I could pull you into all of them. Unfortunately, I don't think having a live feed like Truman Show of me and Anand would be much entertainment value. Document collection D. Thoughts on Merc and US Pharma stocks. Well, Merc is a great catch. What you have said, PE 11, forward PE 8. That's a solid defensive pharma giant. And if you look deeper, the pipeline, patent cliffs, potential growth in emerging markets is what you should pay a lot more attention to, I would say. So deep dive down into that. And I will try and do a full-fledged video on this and cover some other small mid-cap biotech companies in the US. So keep an eye out for that. It's a great suggestion, document collected ND. I'll try and do that. And TCR Investor, different coffee investor that is. I am a tiny speck compared to Buffett. Why should I care? I love this humility, TCR, But don't sell yourself short. You are not a nobody. Buffett moves aren't about his size. It's about the principles. That's why we study Buffett. Not about his size or the amount of money he has. It's about the value and the principles he's instilling. That is what we have to pay attention to. So when he holds cash or he's buying short-term bonds, he's telling us, have liquidity, be patient, don't overreach, is what he's trying to tell you. So whether if you have 10,000 rupees or you have 10 crores, the rule applies to be same. Safety first, TCR Investor. Safety first. Opportunity comes next. Yes, you should definitely care what Buffett is doing, because it's just scale in our world. He's billions, maybe we're in thousands, but it's just a question of scale. Prasha 88. If US bonds are risky, why invest? Is India safe? You have raised a very interesting point. Yes, it is confusing what we are saying right now, but US bonds are volatile, but that is due to the rate cut pause, deficit, inflation expectations. So that's why short-term T-bills is what we're looking at, because that's less exposed to that, and you're not looking for 10-year, 30-year spread, and that's what Buffett is also doing, and that's what institutions themselves are preferring. They're preferring these short-term T-bills. Indian bond market is also good. It's driven by our RBI inflation outlook, rupee stability, but it's not immune to global volatility. That you should keep in mind, and it does offer decent yield also. So it's up to you. If you're looking for Indian shorts, you can look at Indian bonds. If you're looking for American shorts, look at short-term T-bills. Would be what I would say you should keep in mind. Satish 3193. You should share your views, just not analysis. Brilliant feedback, Satish. Noted. 100%. You're right. I'll start making it clear what I personally am doing, whether I'm buying, waiting, or watching. Sometimes I hesitate to do this because I don't want people to follow blindly what me and Anand are doing. But you're right, a little bit of guidance does help. So I'll try and put that more in the videos of what me and Anand are also doing in terms of our own investments and what we're buying and selling. So that gives you guys also some inspiration. I understand that. I appreciate the nudge. So I appreciate that. These are the kind of comments which I read about. Interesting. Keep them coming. And I will try and give you my feedback if I have anything to offer in rebuttal to your comments. So what do I want to talk about today? Today I want to talk about the strategy you should have for the month of June. What should be? The market is stretched, tech is overbought, small investors are quietly shifting to safety. So this month is about going back to basics. I put up a post on this on LinkedIn. I hope you managed to read it. Companies that hold up in tough times are the best ones to hold right now. So I've spoken about this many times. It's not new, and we're going to dive into that in this video. So momentum driven month was May. AI hype, tech was blowout. I think it's going to feel much different. Valuations are too rich. Yield curves are signaling caution, and most people are advising to head towards safety. So let's not, wait for a correction to rethink. Let's prepare for an imminent correction maybe and strategize towards that. And defensive stocks and defensive sectors are what we should look at. And the first sector which we should look at is, of course, healthcare and pharma. Healthcare is not always considered as to be great and flashy as tech stocks and AI, but it's resilient during uncertainty. It is things people fall back on, because basically people cannot stop taking medicine no matter what the economic conditions are. If you're sick, you need to have the medicines. So that is why it's defensive. And we have spoken about it on previous videos. I spoke about Johnson & Johnson. They're a massive company. They're diversified in revenues and consumer health, pharma, medical tech. So it's just not a moonshot. It's a backbone stock. Then Pfizer I've spoken about. They've been beaten down post-COVID. We've spoken about what's happening to them in terms of their pipeline and them pulling out of the weight loss drugs. But I feel the market sometimes underestimates them. They're a very resilient company. That is something you can look at. And these are the kind of companies in defensive stock health sector you can look at to ride out any kind of recession if it does come. I would say it's more like a question of when. Defensive sector which you can consider next is consumer staples, because even in downturn people need to eat. Like in medicines you need to continue eating, so you need your basic cleaning products, your groceries, baby formula, diapers, all these are required. And we spoke about Walmart and how that's a very strong company to hold on. It's a strategic hedge in any kind of downturn. Then of course Target also I spoke about how the valuations of Target are looking very ripe and maybe nice. I did a video on that. Target is something you can keep looking at this month, because when inflation does come back, growth slows down, these kind of retailers tend to hold their ground. So that is the reason why I'm looking at Walmart and Target. In terms of the other defensive sectors, of course, utilities and dividend yielders. Those you can look at energy sectors like Duke Energy and Nexera Energy, because those are In terms of dividend, it's very safe. But I would say the strategy you should have is a combination of offensive and defensive. It's called a barbell strategy, where in one side you stay a little conservative in your outlook. You have healthcare staples and utilities. The other side is optionality. You can look at for some unloved companies which have beaten down but fundamentally strong. So that way you kind of like hedge your bets. So that is what you can look at in the month of June. So reduce your exposure to high PE stocks. If you find some froth in your portfolio, maybe you can book some profit and, as I say, remove the froth and look at reinvesting in these kind of companies, defensive companies, like I said, Johnson & Johnson, Walmart, Duke, and stay liquid, like Buffett is saying. You can, of course, hold short duration treasury ETFs. That's another thing. And you can park your money there in these bonds for 4.3, which is great and is very smart. And keep an eye on earnings, the outlook, right? And guidance from retailers like Target and Pfizer. They'll give you a good idea the tone of July. So capital preservation is first this month of June. So that would be the basic thing I want you to focus on, is to be a little defensive, take a little bit of hedge in defensive stocks, and be ready with liquid cash. Keep it in short-term T-bills and ETFs, and look forward at earnings and see where we are going. So I've given you quite a bit of companies to keep an eye on for this month, in the month of June, and I'm waiting for your comments and your feedback. Like I said, I will work on this pharma, this mid-cap biotech companies, and come out with a video on that soon. So keep an eye out for that. Other than that, other videos are there on the channel, Target, Walmart, Johnson & Johnson, Pfizer. So if you want to see what I thought about that, you can go and catch that on the playlist and see that too. Thanks for being with me today. I hope you enjoyed it. I hope you found it informative and entertaining. And I hope you agreed with my counter rebuttal to your comments. If you would like to offer me some more comments, keep getting down there and keep typing them out, and I will definitely have a look at it and read it and offer my opinion if it's warranted. Thanks for being with me on BeRich today. I really did enjoy spending this 15 minutes with you and having this conversation. And as I promised Rupesh, no more good nights. It is a good evening. See you tomorrow with another one. Thank you.